Good afternoon and a warm welcome to today's earnings call of the Iute Group AS, following the publication of the Q1 figures of 2026. I am delighted to welcome the company's CEO, Tarmo Sild, and CFO, Christel Kurwitz, who will guide us through the presentation in a minute. After that, we'll move on to a Q&A session. And having said this, I hand over to you, Tarmo.
Thank you, and good afternoon, everybody. So let's look at our Q1. We are happy that we have delivered another month, another quarter of growth. And let me jump immediately to the progress we have made with building the digital bank. So let me share with you some of the needles that we have moved during Q1, starting from the share of fully automated loans, where you see that we have reached 35.9%, meaning that 35.9 or 359 euros of all paid out loans are processed fully automatically. And there is no human intervention whatsoever, except by customer who says that I want to have the loan. The share of digitally signed loans, meaning that customer and us can do also some manual operations, but eventually the signature is given digitally. No paper, no pencil, no paperwork, logistics involved, has given a little bit back to 94%, whereas the share of fully automated loan application decisions has stayed exactly at half, meaning that half of the loans are either rejected or approved fully automated, and another half requires some human intervention. You also see that we sell a lot of loans via digital channels, meaning that the whole customer journey, I want to insure myself against some risk versus I get now insured against risk. The share of those customers who do it fully digitally is 8%. Traditionally, there is again some human involvement, but we are pushing upwards the share of customers who do digital only. Also, those needles show us the push towards the change in our societies, because traditionally, where we come from, just let me remind everybody, we come from a situation where the needle sits at 0. So this is kind of long-term view we prefer to share with you also in future if you appreciate it. And it shows overall the change in our societies and how our business model is changing the societies, how the markets, how people consume. 2 more needles, a share of Finco customers using Myiute, that's already 2/3, nearing 2/3, and share of customers who onboard using digital channels, meaning that they never visit the shop or our branch. That is also near 50%. So this is where we are today. And of course, we want to push the needles towards 100. If you ask why, reason number 1 is good for the operating expenses. Reason number good, anything automated can also be driven by AI, further better for expenses, but also better for credit quality management and also customer experience management. So that's the big picture of our evolution. And now, if I move on to the key takeaways, we had strong revenue growth, and especially good revenue growth. I will point out both loans and insurance. Insurance has increased versus Q1 by more than 70%, insurance intermediation revenue. But also the loan revenue increase is worth pointing out, having a regard that we start to originate more and more affordable loans to our customers. The APR stays at 31%. As a forward-looking, not guidance, not promise, but let's say my expectation is that throughout 2026, we will see loan APR stay above 30. We expect to stay above 30. But as compared to Q1 last year, we have given away 5 percentage points, which means significant amount of revenue. And having said that, still the revenue is increasing. While the asset quality is also improving, the cost of risk is declining, and we are covering our covenants. We pay, especially now in the period of intense growth, where we still push the pedal to the metal, accelerator to the floor, we pay extra care to meet the covenants. And we also know that some investors would like to even see the buffers increasing. Buffers are good to the covenants. So if you talk about interest coverage ratio, we have improved from 1.5 to 1.55, and we are pushing to reach 1.65 by end of the year. How to do it? On the one hand, of course, revenue increase. On the other, improved OPEX to revenue ratio, which has been improving in the group, and also improved management of credit risk. So these are the two key takeaways. Of course, we also want to have the funding at lower rates, but that is for the markets and for our depositors to determine. Two more important key takeaways from our building the digital bank. In Moldova, we are about to take another dividend payment approved by National Bank. So our total dividend return from Moldova is basically half of what we have invested into the bank. So the recovery has been nice. We can give each other a high five, but the work continues. The bank is still not fully digital, and we are waiting approval for digital onboarding from Moldovan regulators. Hopefully, we eventually will get it, and the real digital business can start in Moldova too. And in Ukraine, we got approval also by National Bank of Ukraine to become a fully independent operational bank. We are not de facto yet operational, meaning that the services, the value streams have to be set up. We intend to launch as fully digital bank for our customers, our private customers, in Q1 2027. So up until that moment, we only bear the cost, and obviously that cost is also part of the overall group OPEX revenue ratio. So we carry certain drag in belief that it will pay off in future. The total balance sheet exceeds 500 million. You see that there is a decline in total active customer numbers, and let me also address a bit that. There are two drivers behind this. First driver is that we have become more selective. That's the cost of acquiring a larger loan portfolio, issuing more loans at lower APRs, still at improved profitability. And that means we have to say no to some customers who we previously said yes. You see, there is a change, but this is not all the story. There is also other part of the story. Customers can be measured not only by their credit quality, but also by the quality and availability of the data related to the customers. So in line with adding more data science-driven models, which demand more data points, the consequence also is that some customers we are not able to process to the level needed to make a fully automated decision or decision which meets our risk criteria. And that means that, unfortunately, as a side effect, we have also again had to decline some customers who historically maybe we would have accepted. And in the long run, we may see some decline continuing throughout 2026, but not significant. Rather, we are navigating towards additional acquisition of active customers. So one more time, the decline in customers, one is just pure credit risk management and saying no, and saying yes more, saying no to customers who don't meet our increased standards. On the other hand, saying yes to customers who want even larger loan amounts. And on the other hand, also the use of more data points. And if we cannot collect all the data or it's not to our satisfaction, then we cannot do the business with the customer. Net profit 3.5 million euros actually exceeds the one which we delivered last year, Q1, with a caveat. Caveat is that we lost money to FX. That's part of the business. That's almost 1 million. And also, if you want to compare apples to apples, Q1 25 to Q1 26, then in 25 Q1, we had also extra boost from the return of solidarity tax in Macedonia. We had some solidarity tax imposed by the authorities in Macedonia, which we disputed in court. We won, and we recovered 1-point-something million euros, which affected our Q1 25 result, but doesn't give us a boost in Q1 26. Customer performance index, the loan repayment discipline in simple man language, has been constantly improving. OPEX revenue ratio has been constantly improving. Revenue up, as I already said, and also the number of wallet transactions that customers make is also slowly going up. One more time, we expect that wallet transaction activity will start seriously increasing once our bank can acquire customers digitally. So that takes us to the next slide on the loan portfolio development. And Crystal, you still don't want to take over. You let me talk.
Yes, please.
Okay. I continue talking with your permission. So gross loan portfolio reached 381 million. That's another high, despite the fact that Q1 is our low season. Historically, Q1 is always the low season in our business. The loan issuance in Q1 has been somewhat giving back as compared to Q4. That is again related to the tighter credit policy. And last but not least, if we look at the loan portfolio breach, then we see that the sale of non-performing loans now let me help you. During first quarter was zero.
Yes.
So that's also important. Actually, we won't NPLs, but during Q1.
So right now, Tom, we couldn't hear you. The connection is not very stable. So to all the participants, please excuse this interruption. Ladies and gentlemen, please excuse this interruption of the call. We try to redial into the Iute Group, and please stay tuned. Again, ladies and gentlemen, please excuse this interruption. We are working on solving this and reconnect to the Iute Group. Please stay tuned and be patient for a minute. Thank you. So now we can hear you. Hopefully you can see and hear us. Tarmo and Crystal, we can see you both in the meeting room.
Okay.
Welcome back.
Welcome back. Yes.
So we were a good example of how dependent the business is on technology, and also it's an example of resilience. So we are still here. Now, would you please help me? When did the interruption take place? Should we go back to the slide before loan portfolio development, or we continue from loan portfolio development?
No, you were just interrupted, and go back maybe to the last slide and start over that one, and then we'll be at the end of that, and then it should be, I think, Christel's part, and then you took on.
Okay, well, Christel, you still have patience, so I still give the floor to you once we get to the revenues and financial information. But let me just wrap up by the asset quality and pointing out that the share of non-performing loans since COVID has been in constant decline, both from the gross NPLs to gross portfolio ratio and net NPLs to net portfolio ratio. So we are happy with the levels achieved, and now the question is to improve the operational efficiency and also to increase the business volumes. Our favorite CPI, Customer Performance Index, or the ratio of actual money repaid by customers on time versus the money expected to be repaid according to loan repayment schedules, has been also improving. So overall CPI 30, meaning that we give customers maximum 30 days delay tolerance, has been improving to 89.3 percentage points, which in other words means that for every 1 million euros that we expect to be repaid at any given period, for instance Q1, on time was paid 893,000 euros, and 107,000 euros goes into delay, with which we have to put the extra effort in to remind customers or to declare the loan defaulted. Our default standard still remains very conservative versus the overall banking sector. Our default standard is 50 days. We declare the loan defaulted and fully repayable if customer is late more than 50 days. And also we can look at the recent paid outs, the most recent loan groups, customer groups who we have paid out loans, and we see that the CPI is above 96 percentage points. So this basically means that the cash flow from the loans is very strong, and whatever projections we are making based on the APR 30 or 31, for instance, we will see the customers follow through with actual repayments on those APRs. Well, Christel, we have spent now 18 minutes, and I give some minutes to you as well.
Okay, thank you. So, good afternoon from my side as well, and let me cover financial overview. So, total revenue up by 13% from 28.8 to 32.5 million euros, and driven mainly by the growth of loan portfolio, as we had extremely high level of payout during 25 and first quarter 26, as our net loan portfolio on consolidated basis a year rose by 21%. At the Finco side, net loan portfolio even increased close to 27%, and also growth at Bank side by 8%. Finco's revenues up by 13.7%, including growth from loan revenues about close to 11%. Extremely happy to admit that on yearly basis, insurance revenues increased by 71%, representing already close to 6% of total revenues. Adjusted EBITDA from 11.5 million euros to 15.7 million euros, and also triggered mainly by increase of revenues from Finco side plus from Bank side. We managed to improve our quality of loan book, meaning that, as I said, net loan portfolio increased by 21%, but allowances on yearly basis increased only by 3%. And we also managed to keep our operating expenses under control, and on a yearly basis, operating expenses increased by 6%. Net profit at the level of 2.6. As previously also Tarmo said, Forex adjusted net profit for first quarter 26, even 3.5 million euros. Net profit margin during the first quarter, 8%. And as you all know, we are pushing to see net profit margin at the level of 10%. OPEX to revenue ratio. We are really happy to admit the lowest consolidated cost to income ratio at the level of 32.1%. At Finco side, even 28.8%. Yes, there is still efficiency improvement at Enterbank side, as during the first quarter 26, OPEX to revenue ratio at Enterbank side 55%.
I think, Kristel, we have to keep pushing Fincos too. It's not that it's happy grass on the Finco side.
Yes.
And the banks are the big construction sites where there is a lot of dust and noise.
Yes, just at the moment, the gap and difference between Finco and Enterbank is huge, 28 to 55. So in that meaning, more pushing towards Enterbank. Capitalization ratio, also slight improvement compare end of 25, when we had capitalization ratio of 22.5 and now 22.6. And the same applies regarding interest coverage ratio, which was at the end of December 25, 1.53 and now 1.55. So slight improvement regarding interest coverage ratio as well. Total revenue. So total revenues up by 13%. Extremely strong growth of insurance revenues, but also happy about the growth of loan revenues on both sides, at Enterbank side, at Finco side. And also wallet revenues, yes, we were not able to see a strong growth during the 26, but there are reasons behind, as we were not able to start targeted wallet business during the first quarter in Bulgaria.
Also, I think we should add that our countries are slowly but certainly joining single European payment area, SEPA, which means instant payments, instant transfers, cross-border transfers at much lower fees to customers. And because all our economies are integrated with the rest of the European Common Market, then and SEPA, then SEPA payments just come at a lower take rate for our customers. Good for our customers, less revenue for us, especially our bank in Moldova.
So net interest income development. As you can see from the graph on the left side, net interest income on a yearly basis increased by 2%. Increase is based on Finco side. And just one remark that during last 12 months, our funding cost went up, but also funding costs are including one-time expense related to early redemption of 26 bond in May 25. Net interest margin at Finco side also dropped from 24 to 21.8. And risk-adjusted net interest margin from 11.5 to 10.4 related to the higher funding cost, but also we had temporary high level of cash at the Finco side, meaning that cash in a bank account and which was not deployed to yielding assets yet. As you see, at Enterbank side, net interest margins are pretty much stable compared margin recorded during 25. Of course, once again, biggest impact comes from Albania. We see increase coming from Macedonia, and then already followed by Iute Moldova, Bank, and Bulgaria. Moving further, and regarding our operating expenses. As already said, adjusted operating expenses without one-time impact from solidarity tax in Macedonia, we even managed to cut our operational expenses on yearly basis by 6%. So that's why we were able to report extremely low OPEX to revenue ratio on consolidated basis at the level of 32.1. But of course, as we already said, we are pushing efficiency both sides, meaning at Finco side and of course also at Bank side. But still, we are investing to IT, meaning that IT costs remain still high, as we would like to see percentage of automated loans close to 100 at some point. Adjusted EBITDA already covered, but you see that improvement of adjusted EBITDA is driven by higher level of revenues, 3.5 million from Finco, 300,000 from Bank side. We've seen increase of net loan portfolio by 20%. Impairment cost only increased by 3%, and we managed to keep operational expenses so that addition only 700,000 euros compared during the first quarter of 25. So we ended up, or we closed our balance sheet at the level of 527 million euros. As you see, solid level of equity. 81% of total assets are including loan portfolio and cash. At the end of first quarter, we had interest-bearing liabilities in amount of 428 million euros, and mainly covered, or 45% of liabilities are covered by bonds, but 43% are covered by deposits and loans, and 9% belongs to B2B platforms. And once again, we have met the interest coverage ratio, and we even see slight improvement compared to the end of 25. To sum it up, I would like to say that yes, we had a strong first quarter 26. First of all, solid growth of revenues. We managed to improve our assets quality, loan book quality, and we were efficient. First time in history, we were able to report cost to income ratio at the level of 32.1. With that positive approach, maybe let's turn to the questions.
Yes, thank you very much, Tarmo. Thank you very much, Kristel. We now move to the Q&A session. And to all the participants, please feel free to ask a question to the management by raising your hand, pushing the raise your hand button. And if you're not able to speak freely, you can also place your question in the Q&A chat box. Wait a few moments for the participants to write their question or raising their hands. Use the opportunity to do so. Click on the raise your hand button to ask a question. So that's not the case by now. I'll wait a few seconds if there's someone still writing on a deeper question in the chat box.
Well, we have certainly a construction site in the next rooms, in metaphorical sense. So we know what to do with the time.
Well, if there are no questions and everything is clear, the invitation to the participants, if there are any questions after the call, you are very welcome to contact Investor Relations. And if there are no questions by now, we conclude this earnings call. Thank you very much, Tarmo. Thank you very much, Crystal. Again, apologies to the participants for the short technical interruption. And before I close and say goodbye, Tarmo, the last words of these days are yours. Please, for the final remarks, the stage is yours.
Thank you. Thank you for your attention. Thank you for your trust. We continue building while earning money, while remaining profitable. I look forward, and maybe some of us even participate in the bond app if it will be launched. We are contemplating it. Have a very successful day.
Thank you.